Most people think beating the stock market is impossible. Efficient market theorists will tell you that consistently outperforming the market is a fool's errand. Warren Buffett himself has said that most investors should just buy index funds and forget about trying to beat the averages. But there's one man who proved them all wrong. Not just for a year or a decade, but for over 3 decades. His name is Jim Simons, and his track record is so extraordinary that it seems almost impossible. While the S&P 500 returned around 10% annually, Simons' Medallion Fund averaged 66% returns per year before fees. Before fees. After fees, investors still saw returns of around 39% annually. To put that in perspective, if you had invested $1,000 in the Medallion Fund in 1988, by 2018 you would have had over $42 million. That same $1,000 in the S&P 500, about $20,000. This isn't luck. This isn't insider trading. This is mathematics weaponized against Wall Street. Jim Simons wasn't a typical Wall Street guy. He didn't come from finance. He didn't have an MBA. He was a mathematician, a brilliant one. Before he ever thought about stocks or bonds, Simons was solving some of the most complex problems in geometry. He worked as a codebreaker during the Cold War, cracking Soviet codes for the National Security Agency. He won prestigious awards in mathematics. He taught at MIT and Harvard. By any measure, he had already achieved more than most people dream of in academia. But in 1978, at the age of 40, Simons made a decision that would change his life and revolutionize finance. He left academia to start a hedge fund. Not because he knew anything about picking stocks or analyzing companies, but because he saw patterns. He saw that the same mathematical principles that worked in physics and geometry could work in markets. Most hedge fund managers in the 1970s and 80s relied on gut instinct, insider information, and old-fashioned fundamental analysis. They would study companies, meet with CEOs, analyze balance sheets, and make bets based on their judgment about which companies were undervalued. Simons thought this approach was fundamentally flawed. Human judgment, he believed, was too inconsistent, too emotional, too prone to bias. Instead, Simons decided to build something entirely different. He would create a system based purely on mathematics and data. No human judgment, no gut feelings, just patterns in numbers. He started hiring not traders or MBAs, but mathematicians, physicists, and scientists. People who had published papers on string theory, artificial intelligence, and computational linguistics. These weren't people who knew anything about finance. They were people who knew how to find hidden patterns in massive amounts of data. The early days were rough, really rough. Simons' first attempts at systematic trading lost money. His models didn't work the way he expected. There were bugs in the code, assumptions that proved wrong, and market conditions that his equations couldn't handle. At one point, his fund was down significantly, and investors were getting nervous. Some pulled their money out. Simons could have given up, gone back to academia with his tail between his legs, but he didn't. He kept refining the models, kept collecting more data, kept hiring smarter people, and slowly the system started to work. By the late 1980s, the Medallion Fund was beginning to show the kinds of returns that would become legendary. The fund made money in up markets and down markets. During the 2008 financial crisis, when most hedge funds were getting destroyed, Medallion returned over 80%. 80%! During the worst financial crisis since the Great Depression. So what was the secret? How did Simons do it? Even today, the exact details of Medallion's strategies remain one of the most closely guarded secrets in finance. Employees sign ironclad non-disclosure agreements. The fund stopped accepting outside investors decades ago, and now manages only the money of Simons and his employees. But we know some things about how they approach the markets. First, Simons believed in the power of small, short-term inefficiencies. While most investors were looking for big opportunities, companies that were dramatically undervalued or overvalued, Simons was looking for tiny patterns that appeared and disappeared quickly. Maybe a stock tended to move slightly higher on Tuesdays. Maybe certain currency pairs showed predictable behavior right after economic announcements. Individually, these patterns were almost meaningless. But if you could identify thousands of them and trade on them millions of times, those tiny edges added up to massive profits. Second, Simons understood that markets do have patterns, but they're not the kind humans can easily spot. They're buried in massive amounts of data, invisible to the naked eye. His team built computers that could analyze decades of price data across thousands of securities in every market around the world. They looked at not just prices, but volume, volatility, time of day of week, seasonal patterns, correlations between different assets. Everything that could be measured was measured. Third, and perhaps most importantly, Simons removed human emotion from the equation entirely. No matter how strongly his traders felt about a position, the models made the decisions. If the computer said sell, you sold. If it said buy, you bought. There was no room for second guessing, no opportunity for fear or greed to corrupt the process. This discipline is something that sounds simple, but is incredibly hard for most investors to maintain. The technology they built was decades ahead of its time. Remember, this was the 1980s and 90s, long before high-frequency trading became common, long before every hedge fund had a team of data scientists. Simons was building supercomputers and sophisticated algorithms when most of Wall Street was still using phones and gut instinct. Renaissance Technologies, Simons' firm, spent more on computing power than almost any other hedge fund in the world. But even with all this technology, Simons knew that markets evolve. A pattern that works today might disappear tomorrow as other traders discover it, or as market conditions change. So Renaissance built systems that constantly evolved, testing new strategies, discarding ones that stopped working, adapting to new market conditions in real time. The models were never static. They learned and improved continuously. One of the most counterintuitive aspects of Simons' approach was his willingness to be wrong. Most traders hate losing. They avoid losses at all costs. But Simons understood that in a probabilistic system, losses are inevitable. What mattered wasn't being right on every trade, but making sure that over thousands of trades, the wins outweighed the losses. Medallion might be wrong 49% of the time, but if the wins were slightly bigger than the losses, the math worked out beautifully. Simons also pioneered something that would become standard in modern quantitative finance, using alternative data sources. While other investors were looking at traditional financial data, Renaissance was analyzing weather patterns, satellite images, credit card transactions, shipping routes, anything that might give them an informational edge. They weren't trying to predict what a company would earn next quarter. They were trying to predict what a stock would do in the next few minutes or hours based on patterns invisible to everyone else. The success of the Medallion Fund is even more remarkable when you consider the fees Renaissance charged. Most hedge funds charge what's called 2 and 20, meaning 2% of assets under management and 20% of profits. Renaissance charged 5% and 44%. Nearly half of all profits went to the firm, and investors were happy to pay it because even after those enormous fees, they were still making returns that crushed everything else available. But here's the thing about Simons that makes his story even more interesting. He's not motivated by greed. Sure, he became one of the richest people on Earth, with a net worth that peaked at over $30 billion. But Simons has given away billions to scientific research, education, and autism research, which became personal for him after his daughter was diagnosed with autism. He founded the Simons Foundation, which has become one of the largest private funders of basic scientific research in the world. He's funded breakthroughs in mathematics, physics, and computer science. He's supported teachers and education reform. He's funded research into the origins of life and the fundamental laws of the universe. In many ways, Simons saw his hedge fund success not as an end in itself, but as a means to support the kind of pure scientific inquiry he had always loved. What's the lesson from Jim Simons' story? It's not that everyone should go out and start a quantitative hedge fund. The barriers to entry for doing what Renaissance does are astronomically high. You need world-class mathematicians, cutting-edge technology, enormous amounts of capital, and decades of data. Most people who try to replicate Simons' success fail miserably. But there are broader lessons here. First, expertise from one field can revolutionize another. Simons succeeded in finance not despite being an outsider, but because of it. He brought tools and perspectives that Wall Street had never considered. Second, disciplined, systematic approaches beat emotional decision-making. Whether you're a professional investor or just managing your retirement account, removing emotion from the equation is crucial. Third, continuous learning and adaptation matter more than being right initially. Simons failed for years before he succeeded. What separated him from others was his willingness to keep iterating, keep improving, keep learning, and finally, perhaps most importantly, Success in one area of life doesn't have to define you entirely. Simons could have spent his billions on yachts and mansions and lived a life of pure luxury. Instead, he returned to his first love, supporting scientific discovery and mathematical research. He proved you could beat the market, become fabulously wealthy, and still use that wealth for something meaningful. Jim Simons passed away in 2024 at the age of 86, leaving behind not just an unparalleled track record in investing, but a legacy of scientific advancement and mathematical discovery. The Medallion Fund continues to operate, still generating extraordinary returns for the mathematicians and scientists who work at Renaissance Technologies. In a world where financial success is often associated with aggressive salesmanship, insider connections, and cutthroat competition, Jim Simons proved there was another way, a way based on rigorous analysis, mathematical discipline, and the belief that patterns exist everywhere if you're smart enough to find them. He didn't just beat the market, he revolutionized how we think about investing, proved that quantitative approaches could outperform human judgment, and showed that the skills that make you successful in one field can transfer to another in unexpected ways. Jim Simons, mathematician, codebreaker, investor, philanthropist. The man who beat the market by refusing to play the game the way everyone else